We could be starting a depression due to inflation and deflation. Some people call it stagflation. However, the global liquidity crisis makes this one particularly bad. The available money is quickly running out. You also need to be very careful about what you watch on TV right now, since analysts are suddenly linking a slower economy with lower interest rates. You know, if that were the case, Venezuelans wouldn't be eating out of trash cans, and Zimbabwe's economy would be booming. This is not accurate. All of these economists are dealing with the same issue. This year, according to the Bank of England, when all of a sudden the pension funds were compelled to liquidate their Glit-style leveraged government bonds. People who were leveraged in Britain were not aware that pension plans might use derivatives and leverage. You must acknowledge how fantastic this is. This was a mystery. Following that, they had margin calls. They had to sell their gilts in order to obtain cash. Additionally, no one was eager to purchase the gilts. As a result, the Bank of England was forced to purchase the yields from the pension plans. The pension programs would not have succeeded otherwise. You know that this was the canary in the coal mine. This will happen. Derivatives in the US are valued $177 trillion. That amount is astronomically high. 177 quadrillion not. 90% of those derivatives are held by the 4 largest American banks, welcoming minority recommendations for banks. You may want to be in the minority at this moment. I'll talk about the financial aspect. And when you suggest that we take advantage of this once-in-a-lifetime opportunity, we said yes. And it's not buying. We suggested that you carry out a short sale. Shorted sales are traded. You sell short. You can put just about anything in the salad bowl that everyone has been dumping into, and you will make more money than you can imagine. Although there is a straightforward approach, they now provide ETFs that manage your short selling for you. They are designed to appreciate in value along with the index or the sector, and that makes it so simple, since selling something you don't actually own is a concept that most people find challenging to understand. And that's what short selling is. As a result, these ETFs and the fact that the S&P, NASDAQ, and other indices contain them. They come in 4s. Inverse ETFs are the name given to these inverse securities, and it is a straightforward approach. Simply purchasing them will improve their value. We watched the market's price drop, and in 1980, when gold plummeted through $694, we got a sell signal, which we took as a bear market signal. Right now, you want to do the complete opposite. After purchasing put options of bank failure. As a result, several of our put options were actually worth more at the conclusion of the 2-year period than the mining equities that the landlords owned. It was fantastic, but this again shows that nothing endures forever. Additionally, it is usually a good idea to hold some insurance holdings in gold and silver. I kind of prefer gold, but what I actually want are the mining stocks because they won't be seized given the current status of the nation. It was also very similar in the 1930s when gold was literally taken by the government. Right. As a result, we might observe that again. However, they won't seize mines. Gold mining are acceptable. Therefore, research indicates that the largest portion of the stock market and the gold mining stocks arise after the Federal Reserve begins to loosen money from a tight monetary environment. When the Federal Reserve eases, they plunge. This is always a huge trap. People believe that the Federal Reserve is currently loosening. We got to buy it. No, it isn't. If you look at the chart, this is when you have the last big strong drop in all of these assets. Right, so you got to be very careful. If you look for an advisor, find somebody who has been in the markets for at least 44 years. Why 44 years? Because they remember 1978, 1979, 1980. That was a very important period. It was the last time US inflation reached a high. In this context, having a basic understanding of history is essential, yet many of the well-known critics either lack this knowledge or have no interest in addressing it. However, we achieved its pinnacle in 1980, the year the US experienced the greatest inflation rate. The official number is 8.3%. However, Dr. John Williams, who oversees Shadow Stats, says that 69.8% is actually how he calculated it in 1980. Indeed, this places us in close proximity to all of the major European nations, among others. Our inflation rate has increased significantly as a result of their current high double-digit inflation. But the most crucial factor is that our Fed funds rate is currently about 3.7%. According to the Federal Reserve, these short-term interest rates are what we want. People don't talk about inflation because they might not be conscious that they are hiding it from the public when inflation was about 20% Fed funds rate in 1980, similar to what it is now. But there is another issue that is not brought up. Instead of the most recent meeting, Fed Chair Powell noted, "We want the range of interest rates from, say, short-term 90-day T-bills to the long end to long-term bonds above the rate of inflation." Therefore, even if we use their fictitious inflation rate of 8.3%, interest rates will still need to double in the future, regardless of how we feel about them now. We don't manage money, therefore they'll have to go to a point of 3% to 4%. Money managers currently have a conflict of interest. I believe they have the intelligent ones. The fact that they must shut down their company prevents them from saying sell or get the heck out of the market. Indeed, we have a program called Hedge Formulas that is not managed by us. We basically manage 5 portfolios, the model portfolios of it, and the timeliness. As the model changes, people will receive emails, you stated. And that could change. Even if the best performing portfolio among these 5 is up to 18%, the Nasdaq is down 30% for the year. We now have a rise of 48 percentage points as a result, which is a performance that hedge funds would kill for, okay? But the reason it's so easy is that you can keep up with the changes. You get an email that reads, "Look at yourself and see if we made any modifications." If you want to replicate, you can. But since it's hard to tell everyone with a variety of abilities on a single program like this, that's the best course of action. One thing I will suggest is that you should take precautions to keep your money and T-bills safe. The government's 90-day Treasury bill, which is as safe as I stated it is, yielded less than 1% earlier this year. It is now stealing 4.3%, and if I'm correct, it will start yielding 15% very soon. And you don't observe a decrease in price. As shown on television, the bond market managers suggest buying bonds. Acquire bonds, you certainly do. Why? Because the bond market has had almost no liquidity. When someone wishes to sell their bonds and portfolio, the majority of investors should never even think about using margin. They shouldn't use leverage when making stock market investments. You are still forced out of sound investments by leverage. You know, bear rates happen frequently. These are artificial. The market is completely rigged, so they do have these bear rates, and their goal is to get you to leave. The brokerage firm will notify you within 24 hours if you are on margin. The broker will give you the best sell signal because we need $20,000, right? That's a margin call too. Never make it to sale if you receive a margin call. Wow, that is the best recommendation your broker has ever given you. Take a look at the Federal Reserve's updates. Interest rates were left at 0. The interest rate for the Fed's funds ranges from 0 to 22%. Then, overnight, all of a sudden, they transformed. The Fed funds rate is at 3.5%, which is almost 4%. Most individuals who argue that if you have a high, it's bad and you should get out of the bear market are wrong. This is a fantastic chance. Read, research, and keep oneself informed. People think buying stocks is so simple. All they have to do is pick up the phone and tell the broker. However, doing this on a computer makes it even simpler, making it impossible for anyone in the middle to prevent you from acting foolishly. As a result, people need to educate themselves. This is a fantastic chance. The tendencies are beyond our control. People who read books are better readers. You acquire more information than a person has learned in their entire lifetime, over the course of 40 or 50 years. There's no greater deal in the world than buying a book for $20. But since less people read these days, they mistakenly believe that using Facebook as a reading escape will satisfy their reading fix. This year has been absolutely amazing, so it's a shame we need a poor circumstance to make the most money you could ever imagine. So that's for folks who want to make a lot of money. However, there is no other opinion, and regardless of what you do in other areas, you will lose a lot of money. For instance, if you have a house or two inside, their value will decrease significantly, but at least you may make up for it by taking some of the actions we're suggesting. And at some point, that will be a fantastic period for precious metals. But because there is such a monopoly, they are quite difficult to find. The market, I mean. You read about these legal actions taken by regulators against the major banks, including JP Morgan, etc. They receive a few $billion fine for manipulating the gold market, And this market, well, let's just say it's amazing. They received what amounts to a slap on the wrist, yet the manipulations likely generated $30 or $40 billion. They must therefore pay a $2 billion fine. That is a great deal. Your time is your most valuable resource, so spend it wisely. That's my age, is time. Time has greater value. Thank you so much for watching the video.